A fever has broken across risk assets after a 6-week malaise. Speculative leaders shed nearly 18% over the last month as capital rotated into defensive sectors and yield hunters. Now the vital signs are returning to normal range, with tech leading the recovery charge. The question isn't whether this is sustainable. It's whether the infection was truly systemic or merely localized. Risk appetite has returned in earnest, not merely a pulse check. ARK surged 3.36%, while SPHB added 1.63%, confirming that speculative capital knows exactly where to flow when fear recedes. The Russell 2000 responded with plus 0.5%, proving small caps are no longer bleeding into yield. Our metrics show the greed thermometer has climbed back above neutral at 48.52, matching the January reading before the AI fatigue set in. The engine is firing on all cylinders after a month of sputtering. SMH rallied 2.04% as digital infrastructure plays caught the momentum from Bitcoin's rebound. IREN and Applied Digital both climbed 6%, validating the Neocloud narrative that rents compute power to enterprises rather than owning it. YT gained 1.36%, confirming industrial tech is no longer a drag on broader growth. The credit pulse reads clean at 82,100, indicating lending conditions have stabilized without a Fed intervention visible yet. Fear has exhaled in all the right places. UVXY shed 2.67% as hedging capital unwound after months of positioning against volatility. VXX and VIXY both declined 1.3–1.4%, showing defensive vol products are no longer attracting inflows. The VIX itself dropped to 1545, the lowest reading since early July when earnings uncertainty peaked. Our fear index has cooled from a fever of 78,100 down to 62,100. Still elevated, but no longer cardiac-level distress. The economy is coughing up data that confirms soft landing expectations. Oil smashed 5.14%, while gold held steady at $4,723, creating a divergent trade that signals commodity prices are decoupling from inflation fears. Snowflake's news cycle, AI agents pouring more data into the platform, provides fundamental support for tech earnings beyond hype. The Russell 2000 plussed 5% response suggests consumer demand hasn't degraded meaningfully despite high rates. Real Economy Index 68,100, cooling but stable. Safety is no longer the default reflex, it's selective now. TLT gained 1.05%, while bond added 0.51%, indicating duration plays are attracting capital without a full flight to quality. GLD shed 0.23%, as gold loses its safe haven premium when markets stabilize. XLP dipped 1.07%, proving defensive sectors can bleed when the broader market rallies with conviction. The safety trade has normalized at 54,100, protective but not panicked. The villain this week was 6 months of AI exhaustion that created complacency across risk assets. Portfolio capital, sensing fear had been priced in, and fundamentals remained intact, rotated back into growth with precision rather than panic. Tech infrastructure plays led the charge because they combine earnings visibility with the same momentum catalysts that drove Bitcoin. Only these companies report quarterly instead of monthly. The hero, portfolio, has regained breathing room after a cardiac event scare. But immunity building takes time. Don't mistake recovery for reversal yet. The virus can return if tech earnings miss or oil rebounds sharply. Vital signs are stabilizing, with tech infrastructure leading the charge into September earnings season. The canary is singing again, not from fear, but from data confirming risk has been properly priced after 6 weeks of overcorrection. Watch Snowflake and digital infrastructure plays as the next catalysts. If fundamentals hold, we're looking at a genuine recovery rather than a technical bounce.